What if the one tool you use to feel in control of your financial future is actually the very thing sabotaging it? In the palm of your hand, you hold a portal, a direct line to the beating heart of the global economy, updated in real time. Red numbers, green numbers. A constant flickering pulse that tells you whether you're winning or losing the game of tomorrow. We tell ourselves that checking our portfolio, our stocks, our crypto, our retirement accounts, is the responsible thing to do. It's being informed, it's being proactive, but for millions, this responsible act has mutated into a compulsive, anxiety-fueled ritual. A cycle of checking, reacting, and checking again that feels less like strategy and more like an addiction. This cycle creates a paradox. The more information we get, the worse our decisions become. The closer we watch our money, the faster it seems to slip through our fingers. In this video, we aren't just going to tell you to stop checking your phone. We are going to deconstruct this behavior as if it were a psychological infection. We're going to diagnose its symptoms, uncover the flawed logic that allows it to spread, and understand why its supposed cure, more data, more vigilance, is often just a higher dose of the poison. Because only by understanding the nature of this infection can we find the true antidote. Most people believe that checking their portfolio frequently makes them a more engaged and therefore a more successful investor. It's the modern version of reading the morning paper's stock pages, but supercharged. The logic seems undeniable. The market moves fast, and staying on top of it gives you an edge. You see an earnings report drop, you can react. You see a geopolitical event unfold, you can adjust. It's a feeling of power, of agency. You're not a passive bystander to your own financial destiny. You are an active pilot, hands on the controls, navigating the turbulence. You see a stock you love dip 5%. A buying opportunity, you think, feeling smart and tactical. The next day it's up 8%. The green glow on the screen isn't just a number, it's a validation. It's a hit of dopamine that tells you, you were right. You're good at this. This is the myth, that vigilance equals performance. But if this is true, why do decades of studies, from Fidelity to Berkeley, show that the investors who trade the most, who are glued to their screens, consistently and dramatically underperform those who simply buy and hold? If more information leads to better results, why does the data scream the opposite? What if being informed isn't about gathering data, but about managing your own emotional response to it? And what if every time you open that app, you're not practicing discipline, but instead you're failing a test you didn't even know you were taking? To understand this, we need a concept from the world of behavioral economics: loss aversion. In simple terms, pioneers like Daniel Kahneman and Amos Tversky proved that for the human brain, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 hurts twice as much as finding $100 feels good. Now, let's re-examine the act of checking your portfolio through this lens. When you open your app, you are not a rational analyst observing neutral data points. You are a human being, subjecting yourself to a series of powerful emotional triggers. When the numbers are green, you get a mild sense of satisfaction, a small dopamine hit. But when the numbers are red, your brain's ancient threat detection system lights up. It doesn't see a temporary market fluctuation. It sees a predator. It sees a loss. And that pain, that deep, visceral sting of loss, is twice as powerful as the pleasure of the green days. So, by checking daily, you are not creating a balanced emotional experience. You are signing up for a system where the negative inputs will always systematically feel more intense than the positive ones. You think you're watching your money, but you're actually marinating your brain in the chemistry of anxiety and fear. What seems like a responsible habit is, in reality, a training program. It's conditioning you to feel pain more acutely, making you far more likely to panic and sell at the first sign of real trouble. The cycle isn't making you informed, it's making you fragile. If everything we've said is true, then we cannot ignore the ultimate test of this fragility: the market crash. Think of March 2020, or the financial crisis of 2008. These aren't minor dips. They are moments of pure, unfiltered panic. The infection goes into overdrive. In these moments, checking your portfolio is no longer a choice. It's a horrified compulsion. You refresh the screen, and the numbers are a waterfall of crimson. Your life savings, your retirement, your kids' college fund, evaporating in real time, right in the palm of your hand. The pain of loss. Aversion is no longer a subtle psychological concept. It is a screaming siren in your head, demanding that you do something. And what does that something almost always turn out to be? Selling. Selling at the absolute bottom. Locking in your losses permanently out of a desperate, primal need to make the pain stop. The very tool that was meant to give you control forces you to make the single worst decision an investor can possibly make, at the exact moment it matters most. This is the cycle's devastating endgame. So if constant checking amplifies pain and leads to catastrophic decisions in a crisis, what are we really looking for when we open that app day after day? If it's not rational insight, what is it? To answer that, we have to understand the powerful and often toxic allure of the illusion of control. Deep down, this behavior isn't driven by greed, it's driven by fear. The fear of uncertainty, the fear of not having enough, the fear of failing our families or our future selves. Your portfolio isn't just a collection of assets. It's a symbol of security, a bulwark against the chaos of the world. By checking it, we engage in a ritual that makes us feel like we are guarding that security. We are standing watch. It's the same psychological impulse that leads to doom-scrolling the news during a crisis. We mistake the act of observation for the act of preparation. We believe that by simply looking at the threat, we are somehow managing it. But we aren't. We are just flooding our nervous system with cortisol, degrading our ability to think long-term. To really understand the end of this story, we first have to understand why we keep walking into the trap. We have to confront the moments when the cycle seems to work. But I know what you're thinking. What about that one time it worked? What about in the 2022 bear market when you checked, saw a tech stock you loved get crushed, bought the dip, and watched it double over the next year? What about that feeling of pure genius? That moment seems to refute everything we've said. It feels like proof that vigilance pays off. This is the infection's most cunning defense mechanism, the false redemption. That win, that incredible feeling of being right, is not a product of a sound system. It's a textbook example of what psychologists call intermittent reinforcement. It's the same principle that makes slot machines in Las Vegas so addictive. The machine doesn't pay out every time. It pays out just often enough, and at random intervals, to make you believe the next pull could be the jackpot. Your big win wasn't an act of strategic mastery. It was the slot machine paying out. It was a random event that delivered a massive dopamine flood, powerful enough to make you forget the hundreds of other times you checked and felt nothing but anxiety. That one win becomes the justification for the entire destructive cycle. In fact, your greatest success was actually the infection's greatest victory. It wasn't a reward for your vigilance. It was the bait that ensures you stay hooked, forever chasing that feeling while enduring the slow, steady erosion of your peace of mind. So let's assemble the full picture. We start with the myth of the informed investor, believing that more data leads to more control. But our own brain chemistry, specifically loss aversion, turns that data into an engine of anxiety, making us feel the pain of loss far more than the joy of gains. This conditions us for panic, leading to catastrophic decisions during real market crashes. Our desperate need for control keeps us coming back, and the rare random win acts like a slot machine jackpot, addicting us to the very process that harms us. It is a perfect, self-perpetuating loop of psychological pain. The true point of no return isn't when the market crashes. It's the quiet moment of realization when an investor understands that the enemy isn't the market's volatility, but their own compulsive reaction to it. It is the moment they see the portfolio checking cycle for what it is, the disease pretending to be the cure. Now that we understand the machine that moves us, the infection in all its complexity, what does the antidote actually look like? The answer changes everything.